again, I emphasize, let's go ahead and look at the monthly. Now, what do we try to identify with the monthly, right? Because the monthly gives you a larger time frame because you're looking at months versus minutes, right? Or versus days or versus weeks. So when you look at this and you're like, okay, where has this thing spent the most time? When it breaks out or the highs, when it fails, when it comes down, and you can see that's how when you're sitting down and you say, hey, if this thing breaks down, where will it really see some defense, where people will really start stepping up and say, hey, you know what, this thing has been way oversold, one on valuation, but technically, where has the most time been spent? So going back to 2007, you can see like July, the lows were like $60 and the highs were like $70. So we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 months that were spent. So almost a year from all of 2007 was spent between 60 and 70. And then we failed below there. Obviously, 2008, 2009, the market started recovering. And then we hit our head back up against that 60 level that we went sideways at for a year. And previous to that, in 2005, 60 was resistance. That number 4 resistance spot, it could not get above there. And once it did get above there, it spent a year above 60. So when it failed and now we go back up, you say, well, shoot, we were a year at $60. You got to think there were people buying at $60 and higher for a whole year. So when the stock gets back up to that area, that number 4 resistance, we went up to number 5 and then it came down. And again, we went sideways at number 3 resistance for almost another year before, the deep acceleration in 2008. So now you got to ask yourself, even when it bounced back up in 2008, September 2008, that last grasp to avoid drowning, it pushed up to 59.55, almost $60. So you got to think all those people that, all right, 2008, it's been a horrible year, and they knew what was going on in respect that the markets were just selling off, and now the systemic financial issues that existed worldwide, the uncertainty continued to exist. So any opportunity that this thing pushed back up to $60, those people who bought at 60 and it went down to 46, 45, they're like, just get me the hell out of this trade. I will never do it again. So that is translation of how, an area of previous support becomes resistance. Right? Because there was volume there. So you got to understand when we push back up, there's volume overhead. That is also known as supply. There are people that they call them bag holders. They bought late in the game and, when it sold off, they're up, they're stuck. People who bought, you look at July 1st, 2007, somebody bought at $70.75. The next month, the low was $56. They're down 20%. $14 on $70, right? That's 20%. They're down 20% in a month. So, and it might have been, when you look at, from July, I'm just looking, when this thing comes back up, any attempt to get back up to 70, they're like, get me the hell out of this thing, man. I just, I can't take the pain anymore. And that's how, supply and resistance, support and resistance is created by supply, created by volume. So when you look at time spent, we had a year in 2007 of this thing going sideways of $60 support with a couple piercings below and got back above. Once that failed and we came down to, again, 3 resistance now becomes support, we went sideways there at $46, $45 for about another year. So now when we pushed up in 2009, you got to think, well, shoot, that 46 level that was support, it's going to be some resistance. So we had 1, 2, 3, 4, 5 months of farting around before it finally pushed back up to that 60 level. And when it gets up to that 60 level, now in 2010, you can see the failure. It pulled back again. And then it pushed back up to the 60 level again. And again, everybody is looking. And if there's still people that were holding from 2007 now till the end of 2010, 3 years later of dead money, opportunity cost, it's back at 60 bucks. Get me the hell out of this thing, because it went down to 25 and I'm down $35. Or if I bought it at 70, I'm down $45, more than 50% in this trade. So you can understand when this thing goes back up to 60 bucks, how it's going to hit its head up there and fail. Now we can continue going sideways, and eventually that level 4 resistance broke out in August of 2012. So previous number 4 resistance, we went up and then we met resistance number 5 again, which was that 70 level. And what happened? Algorithms and people say, hey, you know what? Last time it was at 70, it sold off. So you know what? Let's start taking our profits. If we bought it at 60 and it goes to 70, that's 10 bucks or 8.5%. Let's get the hell out of this trade. And as they start selling, where does it come? It comes back down to number 4. So if we look at that number 4 and number 5 resistance between 60 and 70 bucks, and you calculate and accumulate all that data, you're looking at 1, 2, 3, 4, 5, 6, 7 years that have been spent between $60 and $70, more at the $60 level. So ultimately, if this market takes a massive dump, you will see the people who got in at 60 and 70 try to support it at 60 and 70 because there is supply below there. So the same people are defending that position. So now as we zoom in, and you see on the monthly shorter term, there's an inverted head and shoulders starting from resistance point 6, which was the April level of 2015. Again, we hit our head now at resistance 6 was a new high, a new impulse, which came in at the $83, $84 level. So now when we pull back, where did it pull back to? It pulled back to the $70 level, which was a previous area of resistance, now becomes support. You know, we had some push through, and then we pushed right back up. And then going into the election, we had a little bit of 2015. So you can see, well, that makes sense. And then 2016, you know, we had a little run up. And then into the election, you know, we had, you know, again, chopping around between 83 and it got down below 70 bucks, but roughly, you know, the $67 to $70 level. That was previous resistance, now acting as support. So going forward now, we see an inverse head and shoulders formation. We got the breakout here in 2019 on August and a push higher. So now when we sit here, before this breakout of the neckline of the inverted head and shoulders, which was resistance point 7, created in the month of September 2018, a year ago. If we pull back now, you would say, well, I'm going to look for a pause at that resistance level number 7, which should now act as support at the 90 level. If that fails, then I got to go back to resistance number 6 at the 83 level, which that should act as support. So if you're sitting there and you're getting at the previous resistance level 7 of $90.39, and you say, hey, you know what, I'm going to give this $1 because if this thing fails, there's a very high probability at a minimum it's going to come back down to the previous resistance number 6, which should now act as support at the $83.98, $84 level. So we have a general market thesis, a macro view, and excuse me, not a market thesis, a target thesis for the company TGT, Target, that, you know, the levels we've spent 6.5 to 7 years between the $60 and $70 level. We know there's a ton of support there. And then also between the 70 and the $83 level, which commenced on November 2014, and then we pierced it and failed in January 2017. We had the sell-off, and then, and it's weird because 2017 was a great year, but it was a great year and you saw the runners move So, consumer staples are kind of, not the big movers. They're kind of a flight to safety. So it makes sense that, it pulled back. And also, the news of Amazon taking over the world and all the retailers losing footage and losing the grip on the hold of their company in respect of margins because they were being chewed up by the behemoth Amazon. So when you look at it, it's like, well, okay, we went sideways and then it broke down. And also one can say, man, this thing pretty much went from 26 bucks up to $83. So now the failure of Resistance 5 to hold, you can see how 2017 we sold off until they turned around and got their metrics together and started competing. 2 years ago, you remember Walmart, Target, all these retailers, Kroger, they were getting their backside handed to them. So they started improving their metrics on online. And some replacement of CEOs, CFOs, COOs, or the C-suite executive level types to come in and change the footprint of this company to remain relevant with current market conditions and respect for what people want, what people need. People want ease. They need things to be simpler, so how not to get into online. So you saw Walmart pick up, I forget the name of the company that gave them access to compete with the Amazons of the world in online. So now we have recovered. We have an inverse head and shoulders breakout, and now it's consolidating, right? And when you look at measured move at textbook inverted head and shoulders, this one is not textbook. However, it is a head and shoulders. Textbook, the right shoulder does not make a lower low than the left shoulder, but it is an inverted head and shoulders. So you look at your shoulder being at 60 bucks up to 90 bucks. That's a $30 move, right? And that's excessive from the lows. So I would take the low that was on January 2019, 64 up to the neckline being roughly the 84, you're looking at $20. So you add $20 on top of 84, takes you up to 104. And that is the conservative view for the right shoulder extension of a textbook inverted head and shoulders. If continuation persists, then you look at the low of the head to the neckline. So you got the low of the head at 48. We'll call it 50 bucks for math's sake. And we got the neckline up at 84 bucks, right? So from $50 to 84, you're looking at $34 on top of the 84, which takes you up to the 118 level, right? So when you're looking at that, well, that would be your ultimate target. And we went up to